In this video, I'll show you how to take a tax deduction for $73,000 or more and invest that money into a solo 401k. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. In today's video, I thought it'd be helpful to cover who can set up a solo 401k, what are some of the mechanics and tax advantages of doing a solo 401k, and then lastly, some best practices and good processes to follow. So let's jump in. So who can set up a solo 401k plan? Well, the bottom line is you have to be self-employed. You cannot be receiving a W-2 employment check from work and then go and set up a solo 401k based on that. You have to have self-employment income in a bona fide business of some kind. So what is a solo 401k? Think of it like your big box 401k plan out there that an employee will contribute to and an employer will provide a match for, only you're doing all of this yourself as the business owner. So we're gonna take the same concept of both an employee and an employer making contributions into this plan, only we're gonna conceptualize it to your business. As a business owner of anything other than a C Corp, a lot of my clients in that realm do see the business's revenue a lot of times as their own income because it all passes through. Even if they're an S Corp and they pay themselves a salary, they'll get some type of pass through that then they just invest or save or whatever on their own personal tax return. Relative to setting up a solo 401k though, we're gonna need to bifurcate these two factors in our mind of both the employee and the employer's contributions to this plan. Any money that's contributed to a solo 401k on the employee side is gonna be called a salary deferral. Any money that the employer side of the plan contributes is gonna be called a profit share. Solo 401ks fall into the same category as any other 401k plan, where the IRS puts forth defined contribution limits in section 415, subchapter C1A. Every year this number seems to change and go up with inflation. However, for 2023, the maximum defined contribution limit is $66,000. So keep that $66,000 in mind as we go through some of the mechanics. In 2023, whether you set up a solo 401k or you work for a large employer that offers a 401k, you as the employee will be able to contribute up to $22,500 for the tax year 2023. And you can contribute that pre-tax or Roth, same thing with solo 401k. As the employee of the business, you can set up your salary deferral to be Roth or pre-tax. In any tax year, the employer is permitted to make up the difference between the defined contribution limit, which for 2023 is $66,000, and the employee's contribution, which for 2023 is upwards of $22,500. The employer can make up that delta, which in this case is $43,500, which is left over. The employer is allowed to profit share a contribution of that size into the 401k for the employee. Now, most employers are not going to do that for everybody. That'd be a tremendously liberal match to help people up to those defined contribution limits, but technically they could do that. And you, as the self-employed business owner, you're gonna wanna be aware of those limits because if you have upwards of 60 grand to put away on a tax deductible basis, you might want to profit share yourself with such a liberal amount. But wait, that only adds up to $66,000. So how did we get to the upwards of 70 grand number quoted at the beginning of the video? Well, that comes into play when we're 50 years or older. As you might know, at age 50 and beyond, the IRS permits taxpayers to make an additional catch-up contribution to their retirement plans. Every year this number seems to change as well, and for 2023, that number is an additional $7,500 that you as the employee would be allowed to salary defer into a 401k type plan. So rather than the employee funding only $22,500 and the employer making up the rest up to that defined contribution limit, you as the employee, if you're over 50, would be allowed to put in both $22,000 plus that extra $7,500 catch-up contribution, which would yield you an employee salary deferral of $30,000. And that catch-up contribution raises the defined contribution limit from $66,000 to $73,500. So now we take the $73,500 number, we subtract what the employee side of the 401k salary deferred, which was 30 grand. In simple math, $73,500 minus 30 grand equals $43,500. The employer profit share did not change whether the employee was 50 years or younger. However, the salary deferral portion, aka what the employee can contribute, that goes up when you're 50 years or older. In total, that means the defined contribution limit does go up when you're 50 or older. But from a mechanic standpoint, the profit share number doesn't change, just the salary deferral number can go up. That means in total, the employer plus the employee are taking a deduction for $73,500. That means you as the business owner are taking a $73,500 deduction from what you otherwise would have to pay federal income taxes on. Now, you might choose not to do all of this in a tax deductible fashion. You might choose to have your salary deferral as the employee be contributed entirely with Roth money. That's totally permitted. Up until the Secure Act 2.0, which passed the other day, you would not be able to do any sort of Roth matching contributions. So the profit share portion, that would have had to have been pre-taxed. However, if you check out my previous video on the Secure Act 2.0, I've got a couple out there, there was some updates relative to profit sharing. So let's dive into that. So immediately in 2023, any sort of company match or profit share is permitted to be profit shared as a Roth contribution. Now that does mean that the employee's taxable income will go up because they're getting Roth contributed money into their retirement account and somebody has to pay federal income taxes and your company is not going to pay those for you. You as the employee are going to have to pay more in tax for this match. Now that also is a form of phantom income whereby you as the employee are paying taxes on money you're not getting in your pocket. So be aware of that. It's not all sunshine and rainbows if your company is making Roth contributions on your behalf, because you will have to pay taxes on that. And odds are you might want to increase your withholding with HR if that's happening on the background, which as you as the single owner operator business, you're going to want to talk to your bookkeeper or CPA on doing that for yourself. In Section 109 of the Secure Act 2.0, starting in 2025, those between the ages of 60 and 63 will be able to make additional catch-up contributions above and beyond just the age 50 catch-up. The wording there is a bit wonky, but essentially what they say is once you're between 60 and 63, so 60, 61, 62, and 63, and you want to make an additional catch-up contribution, you're allowed to contribute the greater of 10 grand or 150% of whatever the typical age 50 catch-up contribution limit is. So simple math, if let's say the catch-up contribution is $7,500 and you're age 60 or 63 or somewhere in between, instead of only contributing $7,500 to the plan as an additional catch-up, you'd be permitted to make an $11,250 catch-up contribution. My gut tells me that those defined contribution limits, the $66,000 we referenced earlier, that will go up when you are between the ages of 60 and 63, but we'll probably want to confirm that with whatever third-party administrator we decide to use for setting up one of these plans. But just know, between age 60 and 63, it's prime time for making additional catch-up contributions, starting in 2025. The other Secure Act 2.0 update that I think is important with regard to solo 401ks would be Section 603 of the Secure Act 2.0. And in that part of the act, it says effective in 2024, if your compensation is over 145 grand, any catch-up contributions you make to a 401k will need to be contributed as Roth catch-up contributions. So that $7,500 number we talked about previously as the catch-up contribution, starting in 2024, that will need to be Roth salary deferred. You will not be able to take a pre-tax salary deferral on that if compensation is above 145 grand. Okay, so what are some best practices if you're looking at setting up one of these and you think it might be in your best interest? Well, number one, you're going to want to make sure you have a good CPA. Number two, you're going to want to make sure you identify a good third-party administrator. And then number three, you're going to want to make sure you have a good financial planner that can help quarterback this whole process. Ultimately, what you want is somebody to take ownership other than you as the business owner for ensuring that reminders are met and contributions are made within certain limits. And these three of the, we'll call it the three-legged stool of advice, will provide you enough support to ensure that this gets done within compliance. So the first thing you're going to want to make sure you establish as a best practice are annual reminders. So those 2 annual reminders you're going to want to meet. It might be simpler just to say by the end of the calendar year, get all this done. However, technically, the deadline for any salary deferrals into the plan is December 31st of that year of making contributions. And the profit sharing deadline is either March or April of the year following, depending on how you have your business set up. The thought process there is probably intuitive, where you as the business, you won't know how much profit to share with you as the employee if you don't actually know what your full profits are for that year. And so there's some time for accounting and profit and loss and stuff like that. Most of my clients keep track of the profit and loss pretty closely. We pretty much know what it's going to be before the end of the calendar year anyways. However, theoretically, there could be some major either cash positive or cash negative outflow in December that could justify making any sort of changes to how much we were planning to profit share to the employee, which is also the business owner. A couple other best practices when it comes to setting up solo 401ks. Oftentimes we're recommending clients roll all existing IRAs into that 401k. That does a couple of things. Number one, it provides ERISA protection. So IRAs aren't bound by ERISA rules, but 401ks are. ERISA provides just essentially some additional protection from lawsuits and things like that. So it's nice to have some additional protection in your 401k. So we oftentimes advise clients roll all existing IRAs into their 401k. To clarify, you can't move Roth IRAs into a Roth 401k once it's in a Roth IRA. You can move traditional IRA money into a traditional 401k, and you can move existing 401k, either pre-tax or Roth, into this new 401k. If, let's say, you had an old employer and you had a pre-tax and Roth 401k over there, you're allowed to roll both of those into this newly established solo 401k. You just can't move Roth IRA into Roth 401k. Another reason why you'd look into rolling all existing IRA money, except Roth, into the 401k is because based on how backdoor Roth IRA strategies work, if it makes sense and is in your best interest to think about doing backdoor Roth IRAs, you're going to want to make sure that in the tax year you're doing a backdoor Roth IRA, you don't have any pre-tax IRA money on the balance sheet. That way you don't run into any sort of pro rata conversion rules when doing a pre-tax IRA to Roth IRA backdoor conversion. I have a video on that you can link to if you want some more specifics on that, but just know there's some ancillary benefits to consolidating things on the 401k other than just simplicity. So calls to action: if you have a pass-through entity that kicks off enough income for this to be a viable strategy for you, look into setting up a solo 401k. I'd highly advise against trying to do all of this yourself. Reach out to a competent planner that specializes in this, speak with your CPA, and then identify a good third-party administrator to keep everybody accountable. If $70,000 as a tax deduction is a drop in the bucket for your business and you could do a lot more than just a 401k, let me know. There's other options out there. We'll push out some videos in the future on these. But for now, just know that there are some larger options out there if you're interested. Hopefully this was helpful. If you have any further questions, drop them in the chat below, send me an email, we'll get you squared away. Have an awesome rest of the week, and we'll chat with you later. Bye.